Well, welcome back to Finance Uncut. On today's episode, crisis investing, gold and silver, and my 25 bagger. All right, so this is the video you've all been waiting for. I've been talking about it for some time. Crisis investing, gold and silver, where I'm going to share some of the gold nuggets in Doug Casey's book, Crisis Investing, in particular with the gold and silver market, and how I used the principles found in this book. And I'll share my 25 bagger in a gold explorer. So, but before we do that, let's just cut to a recent clip with Doug Casey talking about how he's investing in the precious metals market.
To that point, gold prices, Doug. We've heard it for the longest time. Gold is the ultimate hedge in inflationary times. And the number one question I get is, well, then how come gold, apart from the nice few pops we have here and there, isn't headed much higher? Is it because the S&P keeps roaring higher? Is that the greatest threat and competition to gold right now? Is it the S&P?
Let's look at this from a historical point of view. Back in 1971, gold was at $35 an ounce. Now it's at $18.50. So it's had a hell of a good run over the last, dare I say it, 50 years. At this point, it's not like gold is a super bargain, which it has been at times in the past. It's reasonably priced relative to other commodities, relative to the world at large. I'm mainly involved not in gold per se. I think it's going higher because it's the only financial asset that's not simultaneously somebody else's liability, which is very important in a time of financial chaos, which we are entering. I'm mainly speculating in gold mining shares, which in some ways are at all-time lows. Certainly relative to the stock market, they are. Certainly relative to the amount of earning they are. So that's where I am as far as gold is concerned. The shares, not the metal.
Okay, you prefer to be in the mining shares, not the physical metal.
They're a speculation. They're not an investment, but I see a lot of upside in these gold shares.
Yeah.
I suspect that the market has gone from one bubble to another, including cryptocurrencies and so forth. I think at some point the public is, as inflation goes higher, is going to focus on gold. Gold will go marginally higher, and gold stocks, which are just a teeny weeny rounding error of the market as a whole, a little bit of buying can take them double, triple, 10 to 1 when we talk about the explorers.
So the first gold nugget in Doug Casey's crisis investing book is his 10 by 10 approach. So this is 10 investments or 10 sectors with 10% each. So these are unrelated investments, so not 10 junior miners. They also have to have the potential to increase 10x in value and invest over the business cycle, which lasts between 5 to 10 years. So peak to peak and trough to trough. So average holding time would be 2.5 to 5 years. That is from trough to peak. So what you're trying to do is buy when things have bottomed out, when things are out of favor, like the precious metals market is right now, and hold it for 2.5 to 5 years to its peak. So basically investing over the business cycle. Now, this approach does not lend itself to investment vehicles like mutual funds or in Australia, managed funds or popular large cap stocks. Okay, so it relies on volatility, low cap, relatively unknown stocks. So, they're the stocks that I play in as well. Also, it's supplemented by the use of moderate leverage in assets like commodities, convertibles, options, bonds, and even real estate when appropriate. So Jnr Gold Stocks. So Doug says that twice during the last decade, these exploration companies and producers of less than 100,000 ounces of gold per annum have experienced 10 to 1 runs. After each run, the stock's price sank back to its previous lows. Junior golds have languished since about 1987. And he says this is a bet on high inflation and or a monetary crisis. Now, remember, he wrote this in the early 90s, the early to mid-90s. And so when he's talking about this in the last decade, he's talking about that through the 1980s. So this isn't the 1970s that he's talking about. So these have had 10-to-1 runs. He says it's a bet on high inflation and or a monetary crisis. Now, think about today. We've got the junior gold stocks and silver stocks, mind you, and we'll touch on silver shortly, absolutely pummeled, unloved. What do we got at the moment? We've got inflation everywhere. We've got CPI everywhere. We've got a huge debt crisis. We've got a monetary crisis. So, from those factors, the things that I've learned in this book from Doug Casey, the setup is perfect. The macro setup is absolutely perfect for gold and silver, and even more so the miners and explorers. Now, Doug shares this quote from R.W. McNeil, who wrote a book in 1929, just before the crash, called Beating the Stock Market. And he writes this, and I quote, "If there is anything in speculation which requires courage and power of will, it is selling stocks at high prices. If there is any axiom which should be borne in mind in speculation, it is this: don't be afraid to sell after prices have had a big rise and you have a good profit. Let the fellow who buys from you have a chance. And when you do sell, do not rush into the market to buy some other stock equally high with the funds. Take the profits and get out of the market and stay out until there is an opportunity to buy stocks again at prices admittedly cheap. Anyone who thinks he must be in the market all the time can never make any money." So this was R.W. McNeil, who wrote the book Beating the Stock Market in 1929. Those that listened to his advice back then would have done extremely well. Those who didn't, well, you know the outcome. And I think that is a very important quote in the market that we're at right now. So small caps versus blue chips. Doug says that small caps are easier to double from a base of 1 million than it is to double from a base of 1 billion. Another reason is that managements of small companies tend to be more entrepreneurial and less bureaucratic. Small caps management tend to own a lot of the stock, and so they've got a vested interest in seeing it appreciate. Small caps tend to be younger, and youth is quicker to capitalize on evolving trends. The trick is to find them after they've made enough mistakes to know how to survive. And finally, on small caps, since the market has increasingly become a creature of institutions, and institutions generally buy large companies only, the small firms are under-owned solely because they are small. By a happy coincidence, not only do smaller companies have better futures, they are much better values. The danger with small caps during bad economic times is that they may not survive. Small caps are less likely to get help from the government compared to companies that are considered too big to fail. Ain't it funny? He wrote this in the early to mid-90s. And, what happened during the GFC? We all know. He also talks about in the book about shorting, venture capital, mutual funds, so both open-end and closed-end funds, money market funds, treasuries. There's a whole chapter on bonds, annuities, and also Forex or currency. He also has some wonderful quotes throughout the book from some of my favorite economists, Frederick Bastiat. The quote was, "Government is a great fiction through which everybody endeavors to live at the expense of everybody else." What a great quote from Frederick Bastiat there, and so appropriate to today. He also had a quote from Friedrich Hayek, the Austrian economist, in his book Road to Serfdom, where he said, "The more the state plans, the more difficult planning becomes for the individual." So in chapter 18, in the book called Back to the Future with Gold, he lists here Aristotle's 5 properties required for money. Number 1, it has to be durable, it has to be divisible, it has to be convenient, consistent, and also has intrinsic value. But Doug adds a sixth one in here, and that gold cannot be created by the government. And ain't that true right now? He also discusses gold during inflation, deflation, and disinflation, and argues that gold perhaps performs worse in disinflationary times, great in inflationary times, and he argues that it also performs great in deflationary times. So he says in deflation, gold is the only financial asset that's not simultaneously someone else's liability. He argues that treasuries would not be an ideal asset, as deflation would set off all kinds of spending programs and bailouts, causing the government to go from being a questionable risk to a bad risk, as it was forced to borrow on a huge scale to finance emergency spending. Sound familiar? Much which is already mandated by law, while at the same time tax revenues were falling. The other reason would almost certainly result in calls to reinflate as rapidly as possible, which would cause a loss in confidence in the dollar, and gold would soar in that serious deflationary period. So Doug also discusses when to sell gold. Just like myself, we have to measure gold in other assets. So that's something that Doug emphasizes in this book a lot, is not measuring gold in terms of dollars or fiat currency, but in terms of other assets. Doug says he sells his gold, and the same can be said of silver, when it becomes expensive and other assets become cheap. Okay, and that's when he goes in and out, in and out, in and out. And Doug is just an incredible private investor. And personally, I haven't sold any gold. It's been something that I just hold on to and sit and put it away and have confidence that it is a store of wealth and store of value over time. But my silver I have, and I've shared my story in how I use silver, in particular to buy several investment properties just after the GFC in 2011-12, when the market bottomed out. And guess what? I've been selling those properties over the last, this year. And, that's just the whole wealth cycle. So because I learned from this book, and I learned also from Mike Maloney about wealth cycles and about measuring my gold and silver in terms of other assets. And I recommend people do the same thing now. And in chapter 19, which is entitled 1,000% Returns on Gold Stocks, Doug says gold and gold stocks are different, and you should buy gold for one set of reasons and gold stocks for another. He says to look at gold stocks as a hedge, a speculation, and even as a long-term growth opportunity with the right companies. He also says that due to the gold mining industry being so small as an overall industry, only a little of buying or selling can cause wild swings in prices. And he talked about in that video that we started off this video in. And because gold stocks are a direct, though somewhat unpredictable inflation or chaos hedge, they can get large amounts of money moving in and out as quickly as mass emotions can change. So, yeah, once again, that's, some great lessons to learn in where we are right now. He says there are opportunities for juniors to sell and be acquired by the majors, resulting in 3 to 10x returns. There are opportunities for majors to sell to the juniors if the project's too small for them, or they want to devote capital to a higher priority project. He says the junior mining space can be a good substitute for the lottery, even in a horrible market. And he gives examples of stocks that went from like 28 cents to $15 in 3 months based on, drill results. He also shared other stocks in this space that traded between 5 cents and $18 and then back again due to drilling results, debt, and the lack of cash flow profit from mines based on construction price and or the underlying price of gold at that time. So definitely creates those opportunities for those big returns. And I'll share my story in a second as well. So in the book, he also talks about 4 classes of gold stocks. Number 1, majors are large established companies with at least 200,000 ounces of annual production. Number 2 is second tier or developmentals or development companies that are due to be in production in the near term or just beginning production, or don't produce enough to make the major category. These aren't usually followed by the major brokerage houses, only specialty brokers, which means undervalued opportunities can be found. Number 3 is third tier and exploration companies that have worthwhile properties with substantial geological work done. Usually no bankable feasibility studies has been completed. A bunch of my explorers that I personally own have gone beyond this. They've done the substantial geological work, the drilling, all that, and actually have done feasibility studies and should be in production in the next year or two. And then number 4 is wildcat exploration companies. These usually have inexperienced management, little money, and completely unproven properties. This is where the big gains are made and people make millions, but these players can disappear without a trace if they don't hit the big drill holes. And look, when you look at some others like Rick Rule, they kind of stay away from this part. They usually wait until some drilling has been done and some results have come back, and they can kind of get a bit of an estimate on the amount of minerals that they have in the ground, and usually they potentially takeover targets. So Rick Rule talks about he loves being involved in takeover targets, owning these small explorers that get bought out by the larger miners who continually need to add stock to their portfolio. So in chapter 21, entitled Silver and Company, Doug has this quote regarding silver. My argument is simple. Any commodity that is down over 90% in dollar terms and 95% in real terms after a 10-year bear market should be bought almost reflexively. He talks about how silver was the metal of the 1970s when it ran from its fixed price of $1.29 in 71 to close to $50 in 1980 at its crazy top. There was 40-to-1 shots, even over a 10-year period. These are a rare treat. He discusses the price movements from the 60s, from a fixed price right through to hitting almost $50 and then collapsing back to $4. What he does say is what's really going to make the silver market move is the desire of investors, hoarders, and speculators to hold it or sell it. The point is, when the world economy is on the ragged edge, at a time when the metal's real price is down 95% from its high, or a 20-year low in dollar terms, an all-time low in real terms, the gold-silver ratio at an all-time high of around 90-to-1 at that time. What are we in the 70s now? And this after a 10-year bear market, then the next move will be on the upside, and the potential for a meteoric rise is great. It's been 20 years since silver looked this good. And remember, he wrote this book in the early to mid 1990s. And I've actually got a video coming out soon entitled "The Real Silver Squeeze," which I'll touch on, and it's more of an elaboration on this. So he also goes on to share 3 basic approaches to capitalizing on silver situations. So he says, 1, there's coins. If someone asked me now what is the most prudent and intelligent thing to do with a few $1,000s, I'd say to buy these silver coins, put them away and forget about them. Well, you know what? People ask me all the time what to invest in, what to buy. And right now the markets are so crazy, overvalued, and really driven on fake central bank liquidity, right? And, I don't tell people to trade options the way I do, because you need knowledge and experience in that field. Really, the only thing I feel comfortable telling people is, look, go buy some silver coins, go buy some gold coins. Those things are undervalued. Those things will do well if the what really hits the fan. And really, that's the only advice that I can give friends and family at the moment. I can't tell them how to invest, the things that I invest in and the way that I invest, because they don't have the skills and the experience that I do. So the second one is stocks. Most gold and base metals mines produce significant amounts of silver, and there isn't many direct silver players around. So it's usually a buy product, or of other minerals. If silver rises, most mining stocks will get a boost. The real leverage is with outfits that specialize in the actual metal. And I've done a video called "Get Rich with These Silver Stocks," where I shared some of the silver stocks that I own. And so, I'll put a link in the description below. You guys can have a look at that later and then do your own research. Definitely not financial advice, but I just shared some of the stocks, silver stocks, that I'm invested in that I think have got huge upside potential, where I'm looking for these other big, 10, 20x type returns. The other thing is convertible, so bonds of silver companies. So these are the three ways or approaches that he says you can capitalize on the silver situation. So in that video that I did, how to get rich with these silver stocks, or get rich with these silver stocks, I shared this investment that I got into in early 2020, before the whole crash thing. Chalice Mining, it was trading at 17 cents. It was trading lower than that, but I bought in at 17 cents. As of recording this video, it's trading at $9.06 with an all-time high of $10.48 just last month in November. And a $10,000 investment, which is what I actually put into it, would be $532,000 today, or $616,000 at its all-time high. However, I sold mine at $4.33 earlier this year, and I pocketed $254,000. So my $10,000 investment, that was a 25 bagger. So over 2,500% return on that stock. Now, in hindsight, you can say, well, Steve, you could have, if you held on, you could have doubled your position today. But once again, as I learned from this book, and I just shared you some of the lessons Doug said, don't be greedy. When you've got a good profit, don't be afraid to take it and leave some profit there for the next fellow. I think right now in this stock, it's hard profits to make. So I made the easy profits, had a 25 bagger, and I'm now looking for the next 25 bagger. And so I've got a lot of explorers, both gold, silver, and other minerals. I've shared that, copper, cobalt, nickel, zinc, all those metals that are going to do well in the electrification of the economy. You guys know what I think of that. But hey, look, if people want to be stupid, let's profit off their stupidity and their ignorance. But and I'm doing the same thing, and I've done the same thing in the energy space. You guys know my trade on Peabody. That was a wonderful trade, and I took huge profits on that one recently. I've invested into some oil companies, into and they're looking good since I've bought them. But really, my big gains are in the exploration stage, getting in early. Now, not all of them succeed. And some do find a lot of deposit and don't become a producer. They simply get taken over or sold to a mid or large cap mining stock. And so you might make 3 to 5 times your capital in that case. Sometimes they become a producer and become a miner in their own right. And I've shared in other videos the story of Saracen and Northern Star. Northern Star back in 2010 was trading at 5 cents. Hit an all-time high in August last year around $17. So, if you held that stock for 10 years, that is a huge, huge return. And Saracen, very similar. 2015, I think it was trading around the 10-cent mark. And I think its all-time high around August last year was around the $7.50 mark. I could be slightly wrong. Feel free to fact check me on that one. But once again, that was a 5-year waiting period to go from 10 cents to $7.50. And these are where the huge gains are made. And you know, I just want to highly recommend Doug Casey. Follow him. If you're interested in this space and want to learn more and want to learn from the best, you learn from Rick Rule. You learn from Doug Casey. You know, these are the guys you want to follow. These are the guys you want to listen to. Pick up their books. Get their information. Read their newsletters. All of that sort of stuff. So anyway, what do you guys think? Love to see your thoughts and opinions in the comments below. If you did like this video, please hit that like button, guys. Really do appreciate it. Take care, and I'll see you all again on another episode of Finance Uncut.